Hey everyone, welcome back to Talk Tickers, your fast track to cutting through the noise and understanding what really matters from the latest earnings calls. Today we're diving deep into Best Buy's second quarter fiscal 2026 earnings announced August 28th, 2025. On the surface, the electronics giant delivered some, well, pretty impressive beats actually, but the market's reaction that day told a much more nuanced story.
Indeed, it did. We're going to pull back the curtain on those numbers, take a look at management's strategic playbook, and sort of figure out what all of it signals for Best Buy's trajectory moving forward. Our mission, as always, is to give you the full, unvarnished picture, quickly and clearly.
Okay, so let's kick things off with the headline figures. The ones everyone was watching for Best Buy's Q2 FY26, their non-GAAP EPS, that's their core earnings per share, kind of setting aside some one-off accounting bits, came in at $1.28.
Yeah, handily beating the consensus estimate of $1.21.
Right, and revenue also surpassed expectations, hitting $9.44 billion against, what was it, a $9.23 billion consensus.
That's right, a 1.6% increase year over year. And what's really fascinating here, maybe a subtle indicator of consumer resilience, is the comparable sales growth, a solid 1.6% enterprise-wide. Now, that might sound modest, but considering current, inflationary pressures, it's pretty significant. It's actually Best Buy's highest growth in 3 years.
3 years?
Yeah, and breaking that down, domestic comparable sales rose 1.1%, while international comps absolutely soared up an impressive 7.6%.
7.6, okay.
Even domestic online sales showed muscle. They grew 5.1% year over year, and they now represent nearly a third, 32.8% to be exact, of domestic revenue.
So on paper, then, those numbers look pretty solid, right?
Definitely.
Beating expectations on both revenue and their core earnings per share. Yet, like you said, the market's reaction told a very different story. The stock closed down, 3.70% on the day?
Yeah, 3.70% down, with trading volume significantly elevated, too.
Right.
That signals that while those beats were acknowledged, investor sentiment was, let's say, tempered by other factors.
Yeah.
Primarily the forward guidance.
The guidance.
It's sort of a classic case of good news, but maybe not good enough for a market that's really hungry for certainty right now.
Okay, let's unpack this a bit then. If Q2 results were strong, that market reaction suggests there's more beneath the surface. What drove those positive sales, but also what were the profitability dynamics, the things that might have given investors pause?
Well, okay, let's start with profitability. The adjusted operating margin for the quarter was 3.9%.
Okay.
Which is actually a 20 basis point decline year over year.
Right, so 0.2%.
Exactly.
Yeah.
And the gross profit percentage, the money left after covering the direct cost of goods, also saw a slight dip, 30 basis points down to 23.2%.
Okay, so why the dip?
If we connect this to the bigger picture, it was primarily due to a higher mix of sales coming from lower margin categories. Think gaming and computing.
Okay.
While these categories certainly drove significant revenue, really boosted the top line, they did put some pressure on the overall margins.
So Best Buy is maybe sacrificing a bit of profitability now to grab market share in these high growth areas. That makes strategic sense, I suppose.
You could see it that way, yeah.
But it begs the question, if margins were tighter, where did Best Buy actually find that strong sales growth? Which categories really lit up the quarter?
Sales were notably strong in, like I said, gaming, computing, and also mobile phones.
Okay.
Gaming, for instance, experienced higher than expected growth. A lot of that was thanks to the blockbuster launch of the Nintendo Switch 2 back in June.
Right, that was huge.
Oh, yeah. Best Buy leaned into it hard. They organized midnight openings, saw huge customer enthusiasm, even partnered with Nintendo for exclusive game trucks at some stores.
I bet a few listeners pulled an all-nighter for that one. That's a powerful driver, no doubt. But is relying on cyclical launches like that a potential vulnerability? What happens in quarters without a Switch 2?
That's a fair point about cyclicality, absolutely.
Yeah.
But Best Buy's execution around these launches, it clearly makes a difference. And it wasn't just gaming either. Computing continued its, pretty impressive run. It marked its 6th consecutive quarter of growth.
6 quarters straight.
Yep. Best Buy achieved its highest Q2 laptop unit sales in 15 years.
15 years. Wow. What's driving that?
It's a combination, really. Replacement needs, people upgrading, and real momentum from these new AI-capable PCs.
The AI-PCs.
Exactly. The company now offers 125 models of these AI PCs. And get this, nearly 70% of them are retail exclusive to Best Buy.
70% exclusive. That sounds like a massive competitive advantage. Is that translating? Is that drawing people in specifically?
It seems to be. It's definitely a differentiator. Management highlighted that customers are gravitating towards these exclusive models, which helps drive traffic, conversion,
Yeah.
the whole thing.
Okay.
And mobile phones, a category that's seen its share of ups and downs, it's also showed a strong rebound.
Really? Mobile's been a tough nut to crack. How did they manage that turnaround?
Well, mobile phone sales actually grew in both Q1 and Q2 after years of declines.
Oh.
They put this turnaround down to an expanded operating model with carriers like Verizon and AT&T,
Yeah.
so a more seamless customer experience. And these carrier partnerships, they're expected to be in the majority of stores in the back half of the year.
Interesting. Okay, so those are the winners. Gaming, computing, mobile. Conversely, which categories faced headwinds? Maybe explaining some of that margin pressure or the push for innovation.
Right. Home theater, appliances, tablets, and drones experienced declines.
Tablets. I thought those were still strong.
They faced a tough comparison, actually. They were lapping a really strong sales period from last year's new generation iPad launch. So sales were down compared to that high point.
Makes sense. Tough comps.
Exactly. And Best Buy is actively addressing the softness in home theater and appliances. Sharper pricing, tweaking the assortment, more marketing, and faster fulfillment for large products.
Okay, so beyond the quarterly ups and downs, Best Buy also seems to be making some pretty significant strategic shifts, really trying to set itself up for the long term, maybe insulate from those cycles we talked about. What are the key initiatives?
Yeah. Management outlined 3 main strategic priorities. Pretty ambitious stuff. First, they're focused on driving omni-channel experiences that really, resonate with customers.
Omni-channel, okay. What does that look like?
It includes enhancing vendor partnerships for more immersive showcases.
Yeah.
Think Meta AI glasses demos or new small appliance experiences with brands like Breville and Shark Ninja.
Right.
They're also expanding merchandising for high-end TVs, TCL, Hisense, LG, all supported by dedicated experts in store.
So leveraging the physical stores.
Absolutely.
Yeah.
And a key indicator here is that vendor labor investment is expected to be 20% higher in the second half. That underscores the value vendors still see in Best Buy's physical footprint and their expert staff.
That's interesting.
They even announced a fascinating new partnership with IKEA US, piloting these 1,000 square foot areas in 10 Florida and Texas stores, showcasing IKEA kitchens, laundry settings, but with Best Buy appliances integrated.
IKEA and Best Buy, huh?
Yeah, and some locations will also serve as IKEA.com pickup points too.
That IKEA partnership isn't just about selling more appliances, is it? It feels like a really smart move by Best Buy to diversify how they use their physical space, turning what some see as a burden into an asset for, well, cross-category retail. Could be a sign of a bigger trend.
It absolutely could.
Yeah.
It's blurring the lines, creating these multi-brand experiential hubs, a really interesting pivot.
Okay, so that's priority 1, omni-channel experiences. What's number 2?
Second priority is building and scaling new profit streams. And the biggest news here really is the launch of the Best Buy Marketplace. Just happened last week.
Marketplace, like Amazon or Walmart.
Sort of, yeah. This initiative massively expands their online product availability. We're talking 6 times more products than
So 6 times, wow.
Yeah. From both their major vendors and, importantly, new third-party sellers. It's expected to positively impact operating income, even after the startup costs. And it also creates new opportunities for Best Buy ads.
The advertising angle?
Exactly. More sellers mean more potential advertisers for their platform. And speaking of Best Buy ads, their AI marketing campaign already apparently exceeded expectations. Phase 2 is planned for the holidays.
That sounds like a smart way to diversify revenue beyond just, selling boxes. Makes them feel a bit more like a tech company almost.
It's definitely a move in that direction.
And the third strategic priority.
The third is all about driving efficiencies and cost reductions. Classic retail focus, but with modern twists.
Like what?
Supply chain modernization is a big one. 40% of their ship-to-home units are now processed through a new data-driven sourcing solution aimed at cost savings and better delivery times. FedEx is now their primary national parcel carrier. That means better real-time tracking, potentially Sunday deliveries. They're also automating distribution centers with guided vehicles, streamlining things.
Makes sense.
And critically, Best Buy divested Current Health, that healthcare technology company they acquired.
I remember that.
That signals a real tightening of focus back onto core consumer electronics, retail, and services, moving on from things that maybe not generating the financial return they hoped for.
So shedding non-core assets to focus.
Yeah.
Okay. Now, we can't really talk about Best Buy's outlook without addressing the rather large elephant in the room that weighed heavily on management's commentary, tariffs.
Yeah.
How are they navigating that?
Tariffs were definitely a significant theme on the call. While the impact in Q2 was apparently in line with expectations, not really material to the financial results.
Okay.
Management reiterated the full-year guidance because of ongoing uncertainty in the second half.
So the uncertainty is the issue.
Precisely. But Best Buy is actively mitigating the impacts. Vendor diversification, manufacturing flexibility, cost negotiations, the usual toolkit. They're also pursuing country diversification pretty aggressively. For example, China's sourcing is now down to 35% of product cost of goods sold. It was 55% back in March.
That's a big shift. Where's it going?
US and Mexico are now up to about 25%.
Yeah.
And they're also taking selective pricing actions. But importantly, management stressed these are below the headline tariff rates.
How can they manage that?
Well, the company notes it only directly imports about 2-3% of what it sells.
Only 2 to 3%.
Yeah. That gives them quite a bit of leverage in negotiations with their vendors, who are the ones actually doing most of the importing.
That's surprisingly small. Sounds like they have maybe more control or at least influence over the situation than some might assume.
It seems that way, yes.
Okay, so we have a quarter with strong sales, these ambitious strategic shifts underway, and ongoing tariff management. Given all this, how does Best Buy view the consumer right now? And what's the outlook for the rest of the year?
Management describes customers as resilient, but definitely deal-focused.
Deal-focused, yeah, that tracks.
They're gravitating towards predictable sales events, like their Black Friday in July. But they are willing to spend on high price point products when there's a clear need or, compelling tech innovation. Think those AI-PCs are the new switch.
Right. Value and cutting-edge tech.
Exactly. It suggests a discerning consumer, not just spending indiscriminately.
And looking ahead, what's the official guidance Best Buy provided? Did that caution on tariffs translate into a more conservative outlook overall?
They reiterated their full-year FY26 guidance, so projecting revenue between $41.1 billion and $41.9 billion. Comparable sales between minus 1.0% and plus 1.0%.
Okay, so a pretty wide range still on comps.
Yeah. And adjusted EPS expected between $6.15 and $6.30. Now, management did note they are trending toward the higher end of their sales range.
Oh, interesting.
But they prudently maintain the overall guidance, which, implicitly signals caution on margins, likely due to those tariff uncertainties and also the expected mix of those lower margin products like gaming driving sales.
Gotcha.
For Q3 specifically, they expect comparable sales growth to be similar to Q2's low single-digit range, with an adjusted operating income rate roughly flat compared to last year.
So essentially they're saying sales might be okay, maybe even good, but don't expect a huge margin upside. That probably explains the market's reaction then.
I think that's a big part of it, yeah.
What are the key catalysts we should be watching? Things that could really move the needle for Best Buy as the second half plays out.
Absolutely. The ongoing AI PC refresh cycle is a big one. It feels like a genuine innovation driving actual upgrades. Then there's continued strong availability of the Nintendo Switch 2 through the holiday season. That console is just a gift-giving staple, isn't it?
For sure.
The scaling of the new Best Buy marketplace, how quickly can they grow that? And don't forget the anticipated Windows 10 end of support in October.
Ah, right. Forced upgrades.
Exactly.
Right.
Expected to drive significant upgrade opportunities to Windows 11 compatible devices. And of course, any clarity or positive shift on tariff policy, especially a reduction, would be a major catalyst.
Okay. All right. It's time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea, hedge fund analyst style.
Okay. Considering Best Buy's Q2 beat, that negative market reaction, and management's reiterated guidance primarily due to H2 tariff uncertainty, here's a thought for the, let's say, bolder investor.
All right, let's hear it.
The market is clearly pricing in caution, right? But Best Buy's management explicitly said they're trending towards the higher end of their sales range. And crucially, they said their tariff mitigation efforts mean actual cost increases are materially less than those headline tariff rates.
Okay, so the market might be overreacting to the tariff fear.
That's the bet. So the trade idea: initiate a long Best Buy position, specifically targeting this post-earnings dip.
Buy the dip.
Buy the dip.
Yeah.
Paired with a short position in a broad-based consumer discretionary retail ETF. Something like the XRT, which bundles together a lot of general merchandise retailers.
So long Best Buy, short the broader sector.
Exactly. The rationale is this. You're betting on Best Buy's specialized focus AI-PCs, Switch 2, and its unique vendor partnerships, proving more resilient and effective against macro headwinds like tariffs than the market currently believes. While the XRT faces similar consumer pressures, Best Buy's specific strategic shifts the marketplace, the value of its physical stores for vendors. That IKEA deal maybe could differentiate its performance more significantly than just general retail.
So it's a relative value play, almost.
Precisely. It's a bet that Best Buy's, let's call it execution optimism, will eventually outweigh the macro policy overhang, leading to a positive sentiment reset as the second half plays out.
Okay, interesting idea. So wrapping up, we've covered Best Buy's strong Q2 performance, driven by key categories like gaming and computing. We looked at their ambitious strategic initiatives, the marketplace, supply chain modernization, those partnerships.
Yep. And while the market's caution reflected those ongoing tariff uncertainties in a, well, conservative full-year outlook, Best Buy's proactive mitigation strategies and that emphasis on innovation remain really critical themes to watch. It's definitely a company navigating a complex landscape, trying to transform its business model on the fly.
This deep dive really reminds us that even when the headlines seem clear, Best Buy beats. The underlying story, the strategic pivots, the nuanced market reactions often hold the most compelling insights. So a final thought to leave you with. What specific innovation, whether it's AI, maybe another gaming console down the line, or even an external policy shift like tariffs easing, what do you think will truly reshape the consumer electronics retail landscape in the coming quarters? Something to chew on. Thank you for joining us on Talk Tickers. And remember, the information discussed here is for informational purposes only. It is definitely not financial advice.
Stay informed, everyone, and we'll connect the dots for you next time.